Let's get across what is moving markets, certainly how we finished last week and what to expect this week. Peter Mcguire joining us from XM. Pete, a very good Monday morning to you. Well, of course, it was all about the Trump trade post-election. That's starting to unwind a bit. What are your observations?
Well, good morning, Andrew. Well, yeah, it's coming off a little bit. I mean, you've had a very solid lead up over that election campaign period, and this quarter's performed extremely well. And it's probably blowing off a little bit of hot air. You've also had Treasury yields up 70 basis points since September and the rate cut. And you've got a US dollar, King dollar's nearly out of control at 106.70 and really approaching that 107 with a hell of a lot of momentum. So, yeah, you had a bit of a sell-off as far as equities, and we'll just have to see how it rolls into the second half of this quarter.
All right, so we're just taking a look at that snapshot there of the daily performance. Now, of course, gold has been heavily hit of late as we have seen the US dollar climb.
Absolutely, Andrew. I mean, you're looking at gold down from 25.70 sort of handle from that 2,800, so it's well off. And the US dollar, as you said, has had a massive rally. The other currencies have been crushed. And you've got a euro now running at 105. The Aussie peso is sitting at 64.60. So, you've got a yen approaching that 155. Are we going to see intervention from the Bank of Japan? Big week for data this week. And, will the US dollar continue its upward lift? I would say yes.
And of course, Pete, the commodities have been hit hard because of those trade concerns. If Donald Trump follows through with the threat of global tariffs, just how that's going to impact particularly resources and also oil coming off as well.
Oil well off, Andrew, 67. We're nearly at that high 66s for West Texas Intermediate. It's been a great trade to short. Also, Brent's been well off at $71 a barrel. So, yeah, I sit on a number of different panels that I get the opportunity to talk into. And the Middle East guys are saying that you could see crude, the next handle could be 65 for Brent. So we could see certainly a lot cheaper prices in the next matter of weeks. Just got to see if there's any geopolitical concerns that ramp up again or weather outages. But the chart tells a story. It's just one-way traffic at the moment, a big sell-off.
Now, the other issue that's just dragging on the market is the outlook for the Fed funds rate. Now, we have heard from Jerome Powell, also a couple of other Fed speakers, essentially pouring a bit of cold water on the prospect of more aggressive rate cuts. And that's definitely playing out in the market. Perhaps, bringing into question whether we will see another cut in December, or they may push that back a little.
Well, exactly right, Andrew. I mean, if you're looking at the numbers, headline CPI up from 2.4 to 2.6, core at 3.3. There's a 37% chance of the Fed to pause in December, 57% chance to pause in January. So, as you said, there's a number of governors of the Fed saying no way, no more cuts at all. And this is the great concern, is inflation starting to edge up, aggressively to the upside. So they've got to really get this under control, and naturally, a stagflationary environment could be one of much fear to them.
Right, what sort of data are we seeing out of the States at the moment? We did have a retail sales on Friday, slightly warmer than expected there. Also, what are we seeing with the PMIs?
You got S&P Global coming out this week, Andrew, data for November. That's due out on Friday. They're preliminary, of course. We'll just see how that rolls and whether the numbers, we are surprised and they're better than expected, or they're soft. So we just have to wait and see how they run. And, and that, as I said, rolling into the end of the year, it's going to be this next 6 weeks are going to be, I think, quite dynamic for the markets.
All right, more broadly, what are you seeing in Europe at the moment, Pete?
You got S&P coming out on Friday, Andrew, the Eurozone and UK flash PMIs for November. So that's one to keep our eyes on. We'll keep a real close look. And you've got better than expected GDP data for Q3, rebound in CPI inflation for October of less than the likelihood of a 50 basis point cut by the ECB at the upcoming decision. So there's the story there. Eurozone's under a bit of pressure. If you're looking at the might of Germany, they're starting to have large layoffs from their manufacturing, Andrew. So that's not a good sign. And you've got that euro I got, again, those panels that I sit on, interesting to hear the guys, because they're saying 103 is the new home for the euro, and weren't that long ago, it was at 110, 111. So it's sitting at 105. You might be at 103 by end of month.
And the UK, what are you seeing there?
Well, first off, if you're looking at the pound, it's also really under some pressure, 1.26. So there's the first part there. UK, we're just working through the numbers. You've got PMIs again out on Friday, CPI data out on Wednesday, and the Bank of England has raised its inflation forecast, Andrew, for 2025 to 2.7% year on year from 2.2%. So that's not a good sign. So are we going to see more rate cuts out of the Bank of England? I think we'll just have to sit on our hands and look at the pound as probably even further softness.
Now, this week you also get a look at China loan prime rates. No expectation there they're going to move, but what's the market expecting, do you think, from China, given it has been to date underwhelmed by those stimulus measures?
Yeah, I mean, I take that on board, and I also appreciate that it's had a big run up as far as some of those equity markets have performed extremely well. The CSI 300, for instance, back above that 4,100. I'm not sure where it is where it'll trade today. But there's further impact as whether you're going to see a positive tone coming from these cuts. The whole, I suppose, market sentiment has been relatively soft, and you can't get away from the huge overhang as far as debt to GDP, and of course in a deflationary environment. So they've got to do whatever they can to really engage consumption domestically, because it's a weak global consumption for their finished goods, Andrew, and that's not going to wear well once you get President Trump importing all of those manufacturers back to America.